Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We have Greg Mannarino, the Robinhood of Wall Street. Greg, thank you for coming on the show.
Thanks for having me. Greatly appreciate it.
Yes, sir. Yes, sir. Okay, this is your first time on the show. Let's go ahead and give us a couple minutes on your background and how you got into trading, investing, and speculating.
It's a long story. It goes back to when I was a kid. I mean, I don't know where to start. Let's see. My dad got me a job at a Wall Street bank, Bear Stearns, as a matter of fact. Worked there for a little bit. Got myself maybe into a little bit of trouble over there, but that's a whole other story. Did that for a little while, decided it wasn't really the place I wanted to be at the time. Left that, got into medicine, did that for 20 years. And then kind of came full circle, getting back into the financial world. Has always been fascinating to me. I always liked, I like the way things work. I like to figure out why things work. I tinker with old cars and all kind. I like to work with my hands, try to figure out why things are doing what they're doing. Ponder, a cause and effect kind of a situation. So I've always been hooked on this my whole life, pretty much. So, after the meltdown the last time, 2008, I started talking about this stuff on YouTube, and people were like, wow, how do you know this kind of stuff? It's because I study it, all the time. Most people look at the financial markets or the economy and they don't think too much about it. Me, I was always fascinated, again, with how it works and why it works. So I've always been in it, one way or the other. I kind of live and breathe it now. I think that's probably why I'm not very sane, but that's kind of besides the point. But that's really what brought me back, is the meltdown in the financial markets. I lost all my equity at that point the last time here, and that really kind of got under my skin. I saw what happened to people. It bothered me. Very good friends of mine, people got wiped out, and I said, there's something very, very wrong here. And then I started really delving into it more so. Really like full bore. And I found out really really looked into why the system is working the way that it does. And I found a lot of frightening stuff. And I said, hey, you know what? People need to learn about this. And I'm still learning. We never stop learning. But I think pretty much the macro picture I've laid out for people over the years, it's playing out pretty much like we expected it to. I love trying to keep people ahead of the curve, explaining I don't want people to think. I don't want people to hear anything I say without pondering it for themselves, and then doing their own research. Does it make sense with whatever I'm talking about? People know the truth when they hear it, no doubt about it. But I'm not here to tell people really what they should or shouldn't do. I want them to make up their own minds based upon information that maybe I have to give them, and then making up their own decisions as to what's right for them.
Interesting. Yeah, I had a similar story, except it was with the COVID crash when I remember they shut down the stock market, and I pulled everything out and went to cash. And luckily, I don't know if it was any skill or anything, but I was able to kind of catch the bottom and ride it back up. And that's when I delved 100% into this. And I was like, something is wrong with the financial system, and there's something I don't understand here. I need to go all in. What is your macro view of the world economy and financial markets?
Well, let's talk about who runs the show. Is it really run by presidents, kings, queens, monarchs, or dictators? No, the economy of the world, the financial system, the markets are all run by central banks. Basically, they are the government. They have become the government. They dictate everything, even the flow of information. So for me, I see a grand plan that's been put in effect over 100 years ago with the inception of central banking here. Their goal has been since day one to become the lenders and buyers of last resort. They are now pressuring the world into an economic depression on a grand scale here. Central banks collectively destroying the purchasing power of their currency by design, bringing about a neo-feudal system. It's in our face. I mean, it couldn't possibly be more evident, I think, at least to anyone who has their eyes open, as to what's going on here. What central banks have done since the last meltdown here in the stock market, the economic meltdown, the financial crisis, this was all deliberate. And what they're doing now is fostering another way to bring the world economy to its knees and trying, continuing to inflate despite what comes out of their mouth, how they want to control inflation. This is a complete falsehood. I've exposed this fakery since day one here. Central banks are only interested in inflating. The only reason why they are raising rates is so they can cut off the ability of credit to small businesses, pressure the consumer. They have no intention whatsoever in doing a damn thing about inflation. I mean, these 25 basis point hikes to the federal funds rate, and that gets followed by the European Central Bank, and that's followed by the bank. You know, they're working a lockstep, the Bank of England too. It's not doing a darn thing. Like I said, it's not even meant to do that. But this is the lie that they've been telling people. They could actually control inflation if we were to go back to a fractional reserve system. Today we have a zero reserve system. The Federal Reserve is not having the institutions hold any capital in reserves. If they did do that, we could contract the money supply, which is the root cause of the problem, and then we would see inflation go away. But this is not happening. It won't happen, and central banks will continue to inflate by any and all means necessary. So the world today economically is in a death spiral as central banks fulfill their end game to be the lenders and buyers of last resort. And people are being lied to, deceived, told to look here when they should be looking over there. It's always the same story. It never changes. It's always the narrative by the propaganda, the CNBCs, the Bloombergs, the Fox Business, look over here, don't look over there. And people, march to that tune right up until the point where this whole thing melts down, as it always does. And then they wonder what happened. It's always the way. It never stops.
Yeah, don't look at the puppet, Biden. Look at the puppet master, the Federal Reserve. I completely agree. Okay, today is August 22nd, day one of a 3-day meeting with the BRICS. So the BRICS meeting is starting today. There's rumors running through the ethos that they're going to form like a gold-backed settlement system. What are your thoughts on this? Are they going to pull it off? Is this a nothing burger? But what do you see happening?
I think there's a strong possibility that they are going to at least attempt to introduce when we say gold backed or a commodity backed, I think most people have the wrong perception of how this is most likely going to play out. This is a really good question. Most people believe that they're going to have a 1-to-1 ratio. It's not going to happen. If in fact this does occur, and I believe there's a high probability here, it's going to be a fractional backing, mostly fiat. Unfortunately, we're never going to go back to the world is not ever going to be allowed to go back to a commodity-backed currency or a wealth-based system. It's always going to remain somewhat debt-based, and that's exactly, unfortunately, what I believe is going to occur here, one way or the other, with regard to gold backing the BRICS system. I put a lot of thought into it, and I can't imagine another way. But a lot of people I speak to, they don't understand that at all. They say, "Oh no, this is going to be fully." No, it's not. I mean, could I be wrong? Yes, but I doubt it, because they would have to revalue the price of gold multiples higher than what it is today, and I don't see that happening. So it's going to be, unfortunately, a fractional system. That's the most likely scenario moving forward. And people, I mean, this is a threat to the dollar. There's no doubt about it. The dollar, as the world reserve currency, is clearly under threat, and that should really worry people, because again, the enforcement arm of the Federal Reserve is the United States military, including its nuclear arsenal, and they will point that weapon at anyone, inward or outward. So I tell people, be very, very careful what you wish for. We got to take down the central banking system itself. We got to replace this. This is an institution, collectively, central banks working together here, that in my view is public enemy number one, and they need to go. Why do we need their debt-based system? It's an unbelievable thing. They run it all, as I was saying, and they produce one product, and that product is debt. And that's it. I mean, the cash that we work for, it's not ours. It's owned by the issuing central bank, in this case, the Fed, owed back to the Fed, plus interest they create out of thin air. When people go off to work every day, they work for the privilege to borrow the funds from the central bank. It's an incredible situation. It's very twisted. So we got to get rid of central banking. And how do you end central banking? It's very simple. People don't understand how easy it is. To end a central bank, let's say the Federal Reserve, let's stick with that one, for example, you prevent them from issuing $1 single of debt, just one. Once you can prevent that from happening, the central bank system as a whole starts to crack. If we can take down one central bank, we can take down the rest of them in a domino effect. I mean, just as an example here, we had this whole debt ceiling debate recently, all the panic, Janet Yellen, the Treasury Secretary, out every day on CNBC and Bloomberg, oh, we got to do it, we got to raise, but our politicians telling us how important it is, because again, they know the system, it must function, it's debt-based. Without this system, the whole system collapses, and then we could move on to something new. But I mean, there would be economic pain on a humongous scale transitioning from a central bank debt-based system to a wealth-based system, but there's going to be pain anyway. I mean, people are suffering right now today, and the pressure on the middle class is pressure. I've been telling people for 10 years, if you're a member of the middle class, you have a target tattooed on your face, and you can't get it off unless you really understand the system, know what's happening to you, and then take action against it. So that's where we stand. And I think, unfortunately, like going back to this BRICS thing, fortunately or unfortunately, I don't think it's going to play out the way people believe it's going to. People are always looking for some kind of a saving grace. Unfortunately, it ain't happening. The banksters, it's always going to be about a struggle for power and a struggle for control. Okay, this is how the few have controlled the masses since forever, and it's not going to change because of a BRICS alliance, gold-backed currency, fractional, whatever it might be. It's not going to stop.
Yeah, whether it's a CBDC or a COVID, it's all about control.
Yeah.
Okay, Allison Thomas asks, many are saying the market will take a deep dive, possibly in October. What is your view, since it appears the Fed will hold interest rates steady?
Well, look, a couple of things are going on here. Let's look at, people focus on the stock market way, way, way too much, okay? The stock market in aggregate is a derivative, meaning it derives value from something else. And that other thing is the global debt market. The global debt market is a hyperbubble on an epic proportion. It's going to burst. Now, what we're seeing recently in this market over the past several weeks is risk in this market rising because the bond market globally is selling off. People are not paying attention to this. I've been raising people's awareness with regard to the issues with the debt market since forever, explaining that, look, why is it that central banks have chosen to rig rates, keep rates suppressed since the last meltdown? It's very simple. By central banks getting in here and keeping rates suppressed, it opens up a doorway for cash to make its way into risk assets or the stock market. So we've seen a hyperbubble develop in the stock market on the back of rates being suppressed. We've also seen a real estate bubble here develop as well. And forget about the commercial real estate thing that's going to eventually unfold. And I think that's a time bomb waiting to go off. So this mechanism here of suppressed rates and inflating the global debt here to highs that I think most people would have never imagined has created these unbelievable distortions across the spectrum of asset classes. I would go as far as to say, and I've been telling people this for years now, there is not a single asset today that has a real price discovery mechanism behind it. None. How can we have a price discovery mechanism? Price discovery, let's talk about that. Generally, you have a buyer and you have a seller. This guy is willing to buy asset XYZ from seller XYZ and they, for a certain price, so they haggle back and forth and they establish a fair value. When you have an elephant in the room, and that is, or a Tyrannosaurus Rex in the room here, whatever it might be, dinosaur, in the shape of the Federal Reserve or central banks, they're the third player in here. And they're involved in every single transaction, even ones that we make. Why do you think we're seeing inflation right now? Why is inflation running rampant right now? This has been engineered by central banks who are hell-bent on inflating the money supply, period. Anyway, so going back to what I was saying, meltdowns, I hate when people say, okay, October surprise or whatever it might be. No, we have to look at the driver of the market. Today, the driver of this market, the debt market, is sending us a very ominous sign. Right on my website, it's free for anyone who wants to pay attention to this. I developed an indicator. It's my own indicator. It's called the MMRI, Mannarino Market Risk Indicator. Again, free to anyone. It's basically color-coded with the number. It tells you the current level of risk in the market. Right now, if people will go look at that, we are near extreme levels. So, I mean, things are not very pretty here, and this market has been struggling to keep its head above water the past several weeks now. We've seen a significant pullback with regard to the S&P 500, and it's all based on risk. Look at Michael Burry, the big short investor here, just took a huge bet against the S&P 500. His timing, I must say, is impeccable. The guy's probably rolling in cash right now, and he believes this market's got a lot further to fall. However, you got to watch risk. You got to watch the 10-year yield. You got to watch the dollar on a relative strength basis, or better yet, follow my risk indicator, the MMRI. And things are not looking too good right now. Could this turn around? The Fed has three options. Okay, in this case, we're talking about the Fed. The Fed could get in here and buy more debt, suppress rates, have the 10-year yield come down a little bit. And I think that would give some relief to the stock market, and it could potentially go higher. Number two, the Federal Reserve could find a way to weaken the relative strength of the dollar. Number three, the Federal Reserve has a trading desk at the New York Fed. Despite what comes out of their mouth, the Fed buys large cap stocks to prop up the market. One of those three things, or a combination of them, would give the market enough to go higher here. But again, risk is rising. And we got countries like Saudi Arabia, for example, just in the last 2 years, they're dumping the dollar like there's no tomorrow. They're dumping U.S. Treasuries, 41% drop in what they hold in just the last 2 years. This is a phenomenon, again, that's very worrisome. Anyway, but that's where this is going. So I hate timelines. I don't know when it's going to happen. Nobody does, and this has already gone on way beyond what I think anyone would have probably have imagined. But again, it doesn't matter. In my view, what we need to do is prepare for what's eventually going to happen. Meltdown in the debt market, rates spiking in an uncontrolled fashion, putting pressure on global stock markets. We're seeing just a little bit of that now. And eventually cash is going to move. It's going to move into commodities, in my view. I also believe into the big cryptocurrencies as well. Markets generally run in cycles. You got risk on, cash going into equities, and risk off, people come out going into other assets. Cash doesn't grow money wings and fly away. It simply moves from one reality into another.
Yes. Okay. From Thurney, let me lay the groundwork here. Okay. The Chinese real estate market is just a complete S show. All right. Two big Chinese real estate developers are in big trouble. Evergrande recently filed for U.S. bankruptcy. Country Garden looks like it's not far behind. So Thurney's question is, with the Lehman event taking place in China, coupled with offshore treasury dumping, just like you were talking about, what is your short-term outlook for the bond market?
Well, again, that also depends on what central banks do. The central banks are really working on overtime right now to try to at least stop or prevent things from really getting out of hand. I think we're on a knife's edge with this whole thing. Absolutely. All these things are occurring right now. And I think there's a much bigger problem that's going to unfold moving forward. Talking about commercial real estate, I believe that's what this person was referring to here. Empty buildings, entire areas here. And this is a phenomenon that's not just over there. We're seeing a lot of that here. As well in the United States. So this is a time bomb. This is going to go off. And yes, there's a lot of debt linked to that in the form of bonds and everything else. So again, this is a time bomb, and it's going to go off. It's all connected. As I've been, this whole thing, it's a cause and effect. The whole market is always the same. And I believe that this whole issue has been put on the back burner. And by design. I mean, they don't want people to understand that there is a big problem that will unfold. Look, there's no doubt in my mind at all that we are going to end up eventually seeing a complete, total meltdown in the debt market as a whole. Rates are going to go crazy, and it's going to have the completely opposite effect on the equity market or stocks that we've seen since the last meltdown. So this thing is in la la land. None of it makes sense from any angle that you want to look at it. So we are eventually going to hit an inflection point. And I don't think it's going to be by accident. I really believe that these moments are chosen, whether it's going to be in October or tomorrow or a year from now. Central banks have proven that they can prop this up pretty substantially. But what's the side effect of it all? Again, it's inflation. You can't have your cake and eat it too. But central banks are going out of their way here to foster even more inflation. So all of this absolutely is all converging. We have several things converging at the same time. And I think it's just a matter of time before this one little spark sets this off. And maybe it is a commercial real estate meltdown or something along those lines, or another black swan, another crisis, because that's how we function these days. We don't have a normal anything. It functions crisis to crisis to crisis. That's just the way it is, unfortunately. But that does seem to be the new norm.
Yeah, I'm going to share my screen here and bring up the chart of the EDV. So this is kind of a 30-year bond that you can trade. I can't help as a trader, but to notice where we are way down here, hitting a lot of resistance. Do you see any validity to this, or is your kind of base case that rates are going to continue to go higher?
Well, eventually, I'm not saying they may not. We may stabilize. It depends on what happens here. But eventually, we are going to get a full-on meltdown here. It's going to be an incredible situation. It almost looks like you got almost like a double bottom forming over here.
Right here. Yeah. I can't help but not know. And look at, this goes back, what is that, 15 years or something. And
it is kind of interesting the way this is playing out.
Right? You can't help but see it as a trader, right?
Yeah, it's very interesting to see this.
Basically,
That clearly does look like a double bottom.
Stop raising interest rates and go the other way, and then this thing's, going to go back up. But
it does look like that. I mean, in this day and age, I wouldn't bet on it, but it looks like it's going to go. It does look that way. Yes. Nothing makes sense anymore. I mean, technical factors that used to matter, they don't seem to matter anymore. Fundamental factors, PE ratios, forward guidance, whatever. It just also is all just it's a free for all these days. It's very difficult to get your head around any of this. Things that should work just don't seem to anymore. And it makes sense if you can consider what's happening, what central banks are doing. It's just that it's all managed. There's nothing real anymore. We don't have a free market nor a free market economy. It's all managed. It's being run. It's being controlled by these institutions because they're working towards a goal very successfully, unfortunately, and they have everyone distracted. Look over there. Don't look over here. It's always the same.
Yeah. Yeah. Okay. What is from Don Patton? What is the best action to take to protect my health savings account with my credit union so the banking system can't take it from me?
Well, one, I think the guy's in a good spot being in a credit union. I mean, the banks are going, there's a big problem. We had Moody's downgrade a whole bunch of banks and promising to downgrade more. We got Standard & Poor's now downgrading some banks here. Being in a credit union is better than being in a commercial bank for one reason. And when people are going to say, hey, Greg, well, what is that reason? That reason is because these institutions don't operate for profit. They don't take unnecessary risk. So there is step one. Good choice to be in a credit union here. I like that. I belong to a credit union as well. I have for many, many years. I think it's a safer place to be.
They have better balance sheets.
Yeah, they've been around. Yeah, but again, because they don't go out there taking all the risk here and in derivatives. And, you look at the major institutions, I mean, their derivative exposure is unbelievable. If you look at the top three banks, and I could have these in wrong order, it's like Goldman Sachs, JP Morgan, and Bank of America. Collectively, each one of these is holding about $150 trillion in derivatives. No, wow. Each one of these institutions. And this can be, you can look this up. People can look this up. So, this is something that you don't have to worry about, I guess. But look, let me just say this. That's a whole other animal, that the derivative exposure. What is a derivative? A derivative is something that derives value, hence the word derivative, from something else. And with the derivative, when people think about them, they go, okay, so I understand that this asset is deriving value from this one thing. Okay, but now what they don't get is there are layers and layers of derivatives on top and bottom of whatever. And then there are side bets on that too. So this is a whole, it's madness on an incredible scale. And that's going to come home. And that has a lot to do with everything else that we're seeing too. You know, everyone wants to have leverage. And that's what the whole point is with derivatives. But the exposure here, you can lose a lot more. You can lose multiples on your investment by playing with derivatives if you don't play them right. So that's a whole other nightmare that's going to unfold too. But going back to the banking system, look, this whole thing, we're already seeing there's a lot of trouble in the financial system, quite obviously. The financial system, in my opinion, they're consolidating it. I told people over a year ago now that the banks were in trouble. Why? Three things were going on: no deposits, no loans, no deals. And then subsequently, we saw how this manifested itself with the regional institutions who are now being chopped up and absorbed by the larger ones. Now, the larger institutions, they're not immune either. The larger institutions are seeing massive outflows, okay, massive capital outflows. And so there's a big issue there too. So the banking system, again, we're going to face another crisis. Oh my God, I can't believe that. In the banking system, and it's going to come apart too. People need to look with regard to, you have to think, where is the most likely place where cash is going to move in the future? And that's what you should be looking at now. In my opinion, it's commodities. Commodities, and more specifically, silver is my favorite asset on the planet. I've been telling people this for years. I think it's, if you just look at a few metrics here, how does Greg come up with these things? He says, I don't pull these out of a hat. Okay. So you got the Dow Jones Industrial Average gold ratio. I urge people to do their homework, look up the Dow gold ratio, and then look at the gold silver ratio. If you look at these ratios, you can see why I say that silver is the most undervalued commodity on the planet at this time, except for like maybe water, which people need to survive, obviously, you know, but they're already, you know, I don't know how many of people are following the mainstream, and they're already throwing out their little hints here. A scarcity of food and water and resources. And then we got this meeting with the Commerce Secretary going over to China to beg for whatever resources that we need here. There's so many things that are converging right now. It is alarming. It's hard to keep your head around, let me tell you that.
Yeah, it's tough to come up with a commodity that is half the price that it was 40 years ago. You know, I keep coming back to silver at less than half the price now. Now it's $23 or something, you know, and it was 40 years ago. Maybe
well, there was that little hyper bubble there.
What's that?
There was a lot of FOMO at that point, you know, fear of missing out. It doesn't matter what people paid for it even back then. I bought it back then at that price. And I still say, again, meltdown in the debt market, meltdown in the stock market, and cash is just going to move. So I think let's just put another perspective on this, talking about the prices of silver. Okay, where's the bottom in the Dow? No one knows where the bottom in the Dow is. What we do know is the Fed jumped in at Dow 6,000 to start propping up the market with QE1. The bottom could be 6,000 for the Dow, could be lower. Let's just say it's 6,000 in a full-on meltdown. Debt market. And
in perspective, what's it at right now?
34.
Okay.
It was, 34,000 or something like that. So now, you know, we're talking about a massive, massive drop. I think there's a very high potential, because again, think about it. Cash is just going to move, in my view, at least. And I think a lot of people into commodities. So if you got the Dow 6,000, 1-to-1 gold 6,000, and a potential 10 or 15 to 1 for silver, and you can see where we're going with this. So yeah, you're right. Silver was at $46, near $50, but that's going to seem like nothing in my view when this eventually gets rolling.
Well, you mentioned your favorite commodity is silver. What are your runner-ups?
Gold, platinum, palladium, crude oil. I think crude is going much, much higher. The recent drop, we had a drop of crude to $67. I said this is like a really good buying opportunity.
Oh, that was a great one, wasn't it?
Yeah, it was. Then we shot up to 84, and then I said, look, watch what may happen. We had crude pull back to around 77, 78. It was my exact target. I came out and said this is where we should be looking at. Now we're back up, and I think that how assets work is they go up, 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 drop. You find a new floor, and then you go higher. Now sometimes you can retest. I think it's a strong possibility that we do retest. And if we do retest, let's say 77, 78 on crude, and we hold that, crude's going to 90, 95 easy in probably a short period of time.
Yeah. There's a an ETF that I like a lot, XLE, and it's kind of a neat proxy for.
There you go.
And this is kind of right,
dude. I love this. Look how beautiful
right.
this is.
So you're talking about kind of a retest down around here somewhere, right? Like around
maybe a little lower, maybe
a
almost
little
to the
bit
bottom
lower?
of that white band there. And
Okay,
then
that upward channel
yep.
trend
And then
line
it
that
bounce
we've
off of
got.
that. That I
Okay,
mean,
would
that to
love to
me,
see a retest there.
that would be really bullish. I think that's a fantastic chart you have here, and I'm glad you put that up as we're talking about this, because I think we could retest down there to that white level right there, and then bang. It's possible, maybe not all the way down there, but somewhere be a great buying opportunity in my view.
I think so too. I think that would be a we've picked up a lot of subscribers in the last month or so, and they're like, I didn't get into oil. When do I get in? I'm like, be patient. I think it's coming, and it's good to hear that you see the same thing.
Yeah.
Okay. From Nautica, what are your thoughts on investing in emerging markets? What countries do you like? What countries do you stay away from?
I'll say this. And I'm an old school kind of guy. And I think there probably is a lot of opportunity outside the United States. And but I think I still think there's opportunity here as well. And it's a lot simpler to if you live here in the United States to get yourself in the right spots, especially considering where we're going. I mean, I think the whole world, I don't care where you are, is going to end up feeling the pinch of this thing when it comes apart. And I think it's just inevitable when it does. It's going to. I mean, things are just not sustainable in my view. They can't go on forever like this. So I would look for more opportunities, believe it or not, in some big, large cap American companies. I think there's a lot of opportunity there, especially if we get a significant drop in the market, which I think is inevitable, like I said, and get in there and start scooping this stuff up. The large cap companies, the blue chips, they're not going anywhere.
You're talking like
likely.
Exxon.
Yeah. And I think that's what I'll be looking at. I'll be honest with you. I don't think I'll be looking too far. I don't really pay too much attention to emerging markets. Maybe I should. I'd like to see what's going on over there, but I don't think about where I'd like to invest in. For Evergrande is a big example of that. Everyone was all jumping on that bandwagon, and a lot of people they're gonna get killed. It's great. It's crazy.
Yeah. Okay. You also mentioned platinum and palladium in some of your favorite commodities. Why are you bullish on these? When would you consider selling your positions?
Selling them? No. No.
When would you consider?
Oh, when? Well, eventually, the risk on is going to turn risk off, and risk off will turn back to risk on. It's generally the way markets work. But yes, of course, it's a great question. Eventually, we're going to run into that kind of a thing where we're going to say, okay, you know what, maybe it's time to get out. The thing is, what people need to understand when they're looking at, okay, when am I going to close or get into a position? 99% of the times, you're not going to get in or out at the best price. It's just something that investors and traders just got to live with. I think you would probably agree. You could get close maybe sometimes, but you're not going to be able to nail it. It's just too difficult to do. But yeah, eventually we're going to have this is going to flip over, but we are so far from that. I don't even think about it. I haven't even given it even a slight thought yet. We'll see.
See that platinum and palladium are a good deal right now.
I think they are.
Yeah.
I think, in fact, I've been telling people for months and months, commodities exposure, gain commodities exposure. And if you want to have it in your hand, then, if you had to pick one, I'm going to tell people it's silver. It's my favorite of all time. I think if I had to pick how I would say silver 1, gold 2, platinum and palladium, both probably a close third. I wouldn't say I like one mostly over the other at this point. Not too many people hold platinum and palladium. I mean, some do. I have some in my portfolio, physical stuff, but it's probably a very small percentage of my I probably 5% of my metals portfolio is platinum and palladium.
Okay.
The most is going to be silver, second gold.
Okay. I'm in the same boat. Okay. And wrapping up here, I love this question. Anand C asks, what's the ROI? What's the return on investment of the Federal Reserve?
Who knows? I mean, come on, man. You want to? I wouldn't even want to go there. I wish this organization would disappear. I honestly hate. No, I don't think there's a person alive, and I mean this, that hates central banking or the Federal Reserve more than I do. I've been calling this institution out for a decade. I've been telling them that they're public enemy number one. I've been telling people that, they should, we got to get rid of this organization. Central banks are a curse upon this world. And unless we can free ourselves from these institutions, we're all in a lot of trouble. We're all in a lot more trouble moving forward as they extort more and more control. I mean, if you want to bet on the institution, I don't think they're going anywhere. No matter who sits behind the Resolute desk or anything else, doesn't matter. They're too powerful. They have too much influence. They had planned all this out step by step decades ago, and we are just living in the side effect of what they've set forth. Unfortunately, it's a terrible, terrible thing. Like I said, if I get going with the Federal Reserve and central banks, I will probably explode. I can't stand these organizations. I have the deepest. I don't hate anybody or most things, but I hate the Federal Reserve, and I hate central banking as a whole because I see what they're doing to the people of the world. This is all deliberate, and it's going to get worse.
Yeah, I did the math on $20 gold when they were formed back in 1913, 1914, and $1,900 gold now, and that is a 98.9% loss of stolen purchasing power. So they take the cake. But Greg, thank you very much for coming on the show. If our listeners want to get a hold of you, they can go to traderschoice.net and gregorymannarino.substack.com. The links are in the show notes below. Greg, thank you very much. Do you have any final closing thoughts?
No, thanks for having me. I hope we do this again soon. I think we covered a lot of very important stuff.
I do as well. You have a great rest of the day, sir, and thank you for tuning in. Hit the like and subscribe, and we will talk to you next time.